Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5%.
What we just witnessed today was brutal.
Obviously brutal.
Talk about the speed with which we are watching this market deteriorate.
The stock market is having a blast right now with the appearance of a Reddit community known as Wallstreetbeats, which has been challenging Wall Street. Also, some high-end stocks are just booming up like rockets, but all of this is most likely to go down. In this video, we'll be giving you some reasons as to why. Although many saw it coming, the stock market crash of March 2020 took an enormous toll on global economies. It has been nearly a year since that, but if you are thinking that we are past the dangerous part for now, then I have got some bad news for you. After researching a bit about the market, I have found 5 reasons that the stock market is likely to crash. Want to know why? Stick with me until the end. Before we jump into the reasons, let me give you a brief summary about what exactly a stock market crash is. A stock market crash is a sudden and significant drop in the value of stocks, which causes investors to sell their shares quickly. When the value of stocks goes down, so does their price, and the result is that people could lose a lot of money that they invested. Indexes like the Dow Jones, S&P 500, and NASDAQ are the places we look into for the overall measure of the value of stocks. Now, let me ask you, would you like to have a third of your investments just evaporate overnight? That's exactly what happened with the 1929 stock market crash. That stock market crash is the benchmark against which all other market declines are measured. Nearly half of Americans' banks had failed, with 30% of the workforce becoming unemployed then. Due to the amplitude of this crash, it has gotten the name the Great Depression, and it took 25 years to return to pre-crash levels. Can you even imagine the level of the effect it had on the economy at that time? So, as I was saying, there is more likely another time coming soon when the stock market will stumble again, and here are the reasons why. First, new coronavirus variants have been popping up everywhere. No stock market crash discussion nowadays would be complete without mentioning the role that the COVID-19 pandemic could still play. In Wall Street's mind, getting from the start of the pandemic to the end means drawing a straight line from point A to point B. But the reality is that getting from A to B is going to involve countless detours. Moreover, multiple variants of the virus that caused COVID-19 have been documented in the United States and globally during the pandemic. So for the successful vaccination, the US has to ensure enough vaccines to cover the adult population, while also confirming they choose to vaccinate. Also, administering the new variants can't minimize the effect of the existing vaccines. But all of them sound too good to be achieved, even for the most developed country of the world. So that can stimulate a crash. Next, emotions are coming down hard. Operating earnings growth is what drives equity valuations higher over the long term. A host of news events and emotions tends to rule the roost when it comes to the short term. Wall Street bets are the best example of that. Reddit retail investors caused dozens of stocks like GameStop and AMC to swing wildly. They sent a handful of selected stocks into the stratosphere. But the thing to remember about emotion-based investing is that it revolves around sentiment, and sentiment changes on a dime. Also, it often causes investor conviction to overshoot to the upside and downside. Yes, these emotion-based investments can go both ways, increasing the valuation, but at the same time, it also works the other way around. It wouldn't take much for emotion-driven momentum traders to send the stock market into a downward spiral. Third up, stretched valuations threaten the stability. Perhaps the most front and center concern of the market is the valuation of equities, which have been catapulted into a sort of nosebleed territory. If that sounds a little bit too complicated and businessy for you, let me tell you what an equity valuation is. Its purpose is to estimate a value for a firm or its security. Price to earning, or PE ratio, is one way to express the valuation. It is the measure of a stock price relative to its earnings, and it helps you to determine whether a stock is a good investment or not. So the Shiller S&P 500 PE ratio is at 35.02 in March, which is more than double the average Shiller PE ratio over the past 150 years. Sounds like a great achievement by the index, right? Unfortunately, history says quite the opposite. In the previous 4 instances where, because of the bull market, the Shiller PE ratio was above 30, the S&P 500 lost anywhere from 20% to 89% of its value. I'm not saying that that will happen again, but looking back, valuations this high aren't well tolerated for long periods, so you could possibly tell something bad is coming. The next point is a significant decline in buybacks. Now, before you lose your mind hearing all of these technical terms, let me tell you that I'm said to be good at explaining things, so just give me a chance. Stock buybacks refer to the repurchasing of shares of stock by the company that issued them from the shareholders, increasing its ownership. Buybacks have played a notable role in recent years in helping to drive earnings growth. From 2017, as peak corporate tax rates were slashed to 21%, it allowed businesses to return more capital to investors. During the height of the coronavirus recession, bank stocks and a host of brand name companies announced that they'd be reducing their buyback activity to conserve cash. Without this buyback bump, earnings growth could be notably slower than expected in 2021, and ultimately pressure equities, resulting in a crash. The last thing I'm going to go over is mortgage defaults. So far, many lenders have been making allowances for late payments, but no bank can afford to keep delaying its income forever. Combine this with the unemployment rate and the aforementioned temporary nature of government financial aid, it won't be long before mortgage and lending defaults deliver another hit to the stock market, which is exactly what happened during the crash of 2008. No matter what happens in the short term, long-term investors are undefeated if they stay the course. So you should also think of long-term investments and learn which stocks you should choose to be rich by the end of 2021. Click on this link to learn more. So that's it for me about the 5 reasons the stock market will crash soon. For those new to the channel, remember to like this video and subscribe to join the 6 Figures Club and follow along on the journey to wealth.